Thursday, March 1st, 2018, Monaco 64, home of alternative economics and contrarian views. I want to look at the UK economy and dispel the myth that we hear from mainstream economists, politicians, international organizations like the IMF and the World Bank, from the UK Treasury, from the Bank of England, that the UK economy is doing really well, that unemployment is the lowest, since the 1970s, and that everything's honky-dory. And one thing that made me want to do this video is the front page of the FT today. I don't buy this paper every day, but whenever I see interesting headlines, I think it's good to, to show it to you guys. And here's the headline. So it says, freeze on the high street puts thousands of retail jobs at risk. So here we go. We've got Maplin and Toys R Us that went bust yesterday. And I think that there's going to be more than 5,000 jobs lost from that. And we've got Prezzo, which is a Italian it's an Italian chain, restaurant chain. They've going to close 100 outlets, and 4,500 people are going to lose their jobs. So total about 10,000 jobs here. I would say, of course, that Maplin and Toys R Us are probably being affected by Amazon and online sales, but Prezzo, no. And we had also beginning of the year 2018, Carillion, the biggest, one of the biggest construction companies, one of the biggest contractors for the government, went bust. We've got strikes, ongoing strikes by UK university professors because of pensions problems, huge pension deficits that are ongoing, that private pensions have in the UK. So, and the way I want to dispel the myth of this, how can I say this? This myth that our economies are doing really well. And this applies for the US and other big Western or rich country economies. You can do the analysis yourself if you want. But I'm looking at the UK here because that's where I'm based and that's where I'm more interested in. But it applies to the US as well, even more, I would say. So the way I want to do this is look at GDP, which is the measure, which is a measure that I personally don't like. It's a very Keynesian, big government measure. They need to measure it because the government is involved in the economy, but it's the gross domestic product. And the way, basically the simple way that they calculate the components of GDP is the sum of consumption, which is C, investment, which is I, government spending, which is G, and then net exports, which is exports minus imports. That's why when you have a trade deficit that's bigger than expected, that comes out, a lot of economists revise down the GDP because a bigger trade deficit means that the GDP is going to be smaller. And the same thing goes for governments. And the way the biggest way I want to dispel this is because if you add government spending, which is, I read here, is the sum of government expenditures on final goods and services. It includes salaries of public servants, etc., etc., etc. But if the government spends more than it takes in, it has a deficit. So that extra spending that is a deficit will be added on to GDP. So if the government runs a budget deficit of, let's say, 5% for 1 year, and GDP grows at 2%, you need to actually, if you want to find out the real GDP of the private economy, you take that 2% minus the 5% deficit, which is minus 3%. Well, some of you might argue, well, but government spending and the government is part of the economy. True. Technically, you'd be right. But if you think of it in terms of what part of the economy produces real wealth and real services through competition, through the private sector, well, it's the private economy. Every government expenditure can only happen through taxation. If the government doesn't have the taxes, doesn't take in taxes to spend, it will not operate. And in this case, it's besides taking taxes from the private sector to spend, it's also creating spending through borrowing, which is another drag on the private economy. So that's what we need to keep in mind when they come out. For example, I think yesterday there was a revision for U.S. GDP for the fourth quarter. It was revised down from 2.6% to 2.5% year on year. But if you look at the budget deficit, if it's above 3%, or around 2.5%, that means that the private economy didn't grow. And that's what they're not telling people. And that's why when they come out and say that everything's doing, great, the economy is doing well, that's why we don't believe them, because it's not true. So the other thing I want to look at here is the UK budget deficit, right? So looking since 2008, which is a historic year, of course, the great financial crisis, you can see here the UK budget deficit has been 4.9 in 2008, 10.2 in 2009, 9.6 in 2010, 7.6 in 2011, and you can see it's been decreasing, but still for 2016 it was around 3% of GDP. So keeping that in mind, let's have a look at UK GDP for those years. So let's look at 2008. GDP was minus 0.5. I guess that was the year of the great financial crisis. But if you add minus 4.9 to that, you actually get a GDP of a private economy GDP of minus 5.4%. So it was even worse, that GDP. If you just look at the private economy, 2009 was even more horrible. We had a minus 4.2% shrinkage in the whole economy, and the budget deficit was 10.2%. So if you add 10.2 to 4.2, that's almost 15% that the real economy shrunk. The real private economy shrunk. So, and then I'll just look at the figures from 2010 to 2017, and you can see that the highest has been the highest was 2014, where GDP grew by 3.1%. But if you look at the deficit in 2014, the budget deficit was 5.7%. So even then, the private economy shrunk by 2.6%. And the latest year, 2017, I'm not sure what the budget deficit was for that year. I don't have a number for that, but I would say it's not. It wasn't less than 1.8%. It was probably around 2 to 2.5% the deficit. So even in 2017, the economy shrunk. So yeah, things are not well. When they say that we've recovered as an economy, I think it's worse than the Great Depression of the 1930s. We've had the private economy shrink every year since 2008. If it wasn't for government spending and the Bank of England printing money to buy government debt, things would be a lot worse. the unemployment rate, the reason it's the lowest ever is that so many people have given up looking or claiming for unemployment. They might have a very low paying job or more than one or two jobs, but the health of the economy is not there. If the economy was really healthy, government part of the economy would shrink, tax receipts would go up, deficits would shrink and become surpluses, the national debt would go down. We wouldn't have these kinds of numbers. And I will make a positive statement about the UK finances a little later at the end, because I don't want to just give negative information, but I'm going to give you another statistic that will show that this number is even worse. Why is that? Well, it's because GDP usually is calculated nominal GDP, that's GDP not taking account for inflation and the let's say the debasement of the currency, and they adjust, and then you get the real GDP, which is adjusted for inflation. And the way they adjust GDP is something called the GDP deflator. And I looked at the Office of National Statistics website, and the GDP deflator, I looked for every year since 2008. And for example, in 2008, the GDP deflator was 1.7, which was higher than the RPI, which is the retail price index. So they actually deflated the GDP by more than the rise of cost of living, which is fine. But when you look at all the other years, for example, RPI in 2009 was 2.4%, but they only took out the deflator for 2009. It was only 0.7%. And what does that mean? Well, that means that they only deflated the nominal GDP by 0.7%, while RPI, which is the broadest measure of inflation, which includes rents, housing, that went up by 2.4%. So you could argue that that's like another extra 1.7% that they added to GDP, which is not real, aside from the budget deficit. Then you look at 2010, the deflator was 0.8, the RPI was 4.8, 2011, 0.3 deflator, RPI 4.8, 2012, 2.2 the deflator, higher, but the RPI was 3.1. And then last year, they only used a 1.1% deflator for the GDP, the nominal GDP, to get the real GDP, and RPI was 4.1%. So that's why people feel hard up. That's why people can't afford things. That's why there's so many food banks still in the UK. And that's why also when we're told by the so-called experts, you know, at the Bank of England, at Barclays Bank, or at the World Bank, at the BIS, at the UK Treasury, at the World Economic Forum in Davos, Switzerland earlier this year, that the economies are in a sweet spot, everything's going great, we've got growth again. It's all really rubbish, in my opinion. But and why am I trying to expose this? It's not that I want to prove anything. I just want to let people know why it doesn't feel right, and that's why. And hopefully it will help people make economic decisions in their everyday life to know where we really are in terms of the UK economy. Well, I said earlier that I was gonna show you a good part of the UK economy or the finances. And I saw this from dmartinobooth.com, and she posted, she talked about a tweet from Bloomberg's Lisa Abramovitz. And basically, it's the average term to maturity of outstanding marketable debt for each country. So that basically means the average maturity of the debt that a country has. You know, U.S. Treasuries, UK gilts. And you can see there the U.S. Average term to maturity of their debt is less than 6 years. So that means that in the next 6 years, all the U.S. debt will come, you know, on average will come to maturity. So if interest rates increase a lot in the next year or two or next 3 years, they're going to have trouble. But if you look at the right-hand side of that chart, the UK average term to maturity is actually 18 years. I remember a few years ago it was about 7. So that's the only thing the UK government has going for themselves, is that they've, you know, as Danielle DiMartino Booth says here, and I quote, "The United States wasted a great opportunity to extend the maturity of its sovereign debt, while Britain seized upon the lowest borrowing costs in 5,000 years as no other." So what does that mean? That means that if interest rates start going up, spiking higher, in the next year or two, the UK government won't be as in much trouble as the other countries, because a lot of their debt has a long time to run and they won't have to refinance until later. The people who are going to get hurt are the people holding that debt. But I would also argue on the negative side of this, if you look at this chart, that the biggest buyer since 2007 of UK debt has been the Bank of England. You see, they now own 25%. It's the black pie part of the pie there on that chart. They used to own almost nothing in 2007. So I would argue it's been the Bank of England that's really bought a lot of this debt and extended the average maturity of UK debt. The real health of the UK economy and why things don't really match up in the real world and you know, they don't match up with what we're told by, you know, the elite and the establishment. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet, and you can also follow me on steemit.com and on Twitter, and I'll talk to you later. Bye.